All right, so let's have a look at GB Hi-Fi. It's very well-known brand in Australia, and interesting enough that like previously I thought that GB Hi-Fi is GB Hi-Fi and Good Guys is a completely different company. Actually, GB Hi-Fi owns Good Guys. They're actually partners, and you probably noticed GB Hi-Fi mostly sells electronic, like more like microphones, mobile phones, computers, all this kind of equipment, whereas Good Guys, they have a lot of like washing machine, freezers. Like that's why if you look at their location, Good Guys very often located and they have independent buildings like here, right? Whereas GB have are usually located in shopping centers, so where people just come and buy small items. Whereas here they need good parking spot, they have to come collect something big, you know. So and that's what we have. So altogether, GB Hi-Fi Corporation, they have about 300 stores in Australia and in New Zealand. So this includes both Good Guys and GB Hi-Fi. Okay, so both of them. And also they sell a lot online. And actually, the fact that they were selling online helped them to go through the COVID period very successfully compared to other retailers, which were nearly like close to liquidation, let's say. And like GB Hi-Fi and Good Guys, they had this buy and collect or delivery online. So you could buy stuff online and it would be delivered to your place. And they were really efficient in this particular field. Even now they sell a lot of products online, but also you can buy online, but then go and pick it in the store. So this is because a lot of products they have now pre-ordered. So you go, you pay, but then you receive the product like a few weeks later, okay, because it's not available in the store. Okay, so this is the GB Hi-Fi story. Now, it's actually started more than 20 something years ago. So it's, I think in 90 started GB Hi-Fi. So quite a while ago. So it's already well-established company on Australian market and now also in New Zealand market. So let's have a look at their financial performance. Now, I took this data from TradingView because I don't have information on value line and I don't have information, like there is no information in value line for Australian companies, and also in Guru Focus I don't have subscription for Asia Pacific region. So that's why I'm using information from TradingView. Now, I could take information from their website, but on their website, the consolidated statement was only from 2018. So I wanted to go a bit like further back. So in order to see more years to analyze it, so that's why I took from here. So there might be some discrepancies. So if you compare it to the actual earnings, because sometimes free sources are not that reliable, but still the picture, like the major picture, we will see here as well. Now, as you can see, total revenue. So like I don't know what it was in 2015, but we can see it grew like 8%, and after that the growth continues, like it's continuously growing. So we can see that every year it has added more and more and more. And actually during the pandemic time from 2019, 2020, 21, the growth was pretty good, like 11 and 12%. Okay. Last year, like which we have just closed in June, so 2022, it's 3.5% growth only in sales, but I presume it's because there was a huge boost of sales during this period, and then a lot of people bought mobile phones, bought all this equipment for mobile, I mean online entertainment, gaming. So like it's expected that then it could be a bit quieter period, but still they have the growth. Okay. Now, if you look at gross profit also increased. So constantly increasing, constantly growing. So there wasn't even 1 year when the company kind of reduced their earnings. Operating income, same story. So with constant growth, you can see that actually operating income during this COVID time, it was like 24% in 2020 and 44% in 2021. Very impressive growth. Okay. Now, if we go for taxes and net income, just pure net income, you can see that Actually, during 2021, they went net in 67%. So it's fantastic. And now 7% growth. So it's still impressive. Pretty good growth for such a big company, because it's 5.6 billion capitalization in Australian dollars. Now, I want you to pay attention to the earnings, diluted earnings per share. So we can see it's $4.77. So at the moment, the price for the share is $40, $40 and like 80 cents. I'm not sure what price it closed, but somewhere at that range. So we can see that P ratio is actually lower than 10. So it's 8.5, something like that. So just remember this number, and after that we'll, when we see on the next slide how much people usually pay for this company, we can calculate the future projection, right? So how much it's going to be in the future. Then if we look at, so they're like, this I took from their website. So there is pretty good information. Also, there is a webcast there. So if you want to learn more about GBHiFi internal group, so you can go and listen about that. But basically, you can see that this is financial year 21 and 22, and this is increase in their sales. So in total, 315 million Australian dollars, so which represents about 3.5% in total. New Zealand practically didn't grow that much. Okay, just 0.3%, but good guys in GBHiFi Australia, they grew. Just a second. And you can see that online sales were up 52% to 1.63 billion, represent 70% of total sales. Okay, and I presume one of the big things is attributed that there were online sales, so you don't have to incur additional cost to put this stock on the market and not in the market, in stores, right? So because they just click on the button on their computer and then they start selling it.
Also, they probably don't have a commission to pay to the salespeople as well.
That's true as well. That's true as well. Yeah, and probably they don't have to pay commission to the store as well, to the managers, because it's not attributed to the store. It's actually attributed to the like general corporate, right, companies. So, and also they probably don't have to pay for delivery to the store, because it's probably sent directly from their warehouse. Whereas if you buy it from the store, it has to be delivered from warehouse to the store first, and after that. So yeah, so the more online sale they have, the higher margin they might have. And so this is the balance sheet for them. We can see that total assets are growing. So in 2016 they had only nearly $1 billion, and we can see it's practically consistent growth, except a couple of years, right? But in January now it's $3.1 billion total assets. We can see that current assets right now it's $1.4 billion, and total current liabilities $1.3 billion. So they have roughly $110 million in cash, so which is available there, even if the surplus. It's not that much. Ideally, you want to have total current assets 1.5 times higher, but in this particular case, probably it's not that bad. Okay, in this case. Now, total liabilities, we see it growing as well from $593 million to $1.8 billion. But then if you compare the growth in assets and liabilities, so you will see that liabilities growing slower than assets. And that's why we have positive growth in shareholders' equities. Okay, so total equity, we can see grew from $404 million to $1.28 billion, which is great. All right, so it means that the shareholders have this amount of money totally. So and then if you take this number, $1.28 billion, and then divide by amount of shares outstanding, you get $11.71 per share book value. And current price, as I said, it's $40. So it means price to book value it's close to not 3.8. So which is a bit on the higher end. Warren Buffett, for example, he's trying to find companies with book value, price to book value less than 2.5. But in reality, it's more and more difficult to find companies like that because a lot of companies try not to hold huge amount of assets. Right? So, and especially it's a retailer, it's more important the turnover there, which they have. This is a balance sheet, and let's look at cash flow. Cash flow from operating activities. First, we can see it's constantly growing. Not constantly, actually, it's going to jump up in 2020, then it did down. So 627 million, but it is positive. Then cash flow from investing activity, you can see it's negative, but it's pretty, for the last few years, about the same level. So I presume it's they might allocate for new stores, maybe some equipment, etc. Right? So roughly the same amount, 57 million, goes to like investment activities, so buying assets. Then we can see that cash from financing activity also is negative. And we can see that what we do, they buy stock. We can see for 278 million, they bought stock back. So it's a good idea to buy stock when it's cheap. And like it was cheap for the last few quarters, right? So, and also they are paying quite huge amount in dividends. Okay, so, and we can see if we look at total free cash flow, so it's a positive number, which is pretty good, right? So they have access to cash, so they are not in a position where debtors can come and ask them for money and they won't be able to pay. All right, so this is a good thing for them. Now, let's have a look at some ratios. We can see that in 2016-17, P ratio was about 15. Then, like 2 years, 17 and 18, P ratio was around 11, 12. And then again, went back to 16. So that's the average annual ratio. So it means that during the same year, the P ratio can be 18 and, for example, 13, right? So between then and then, when they calculate the average, it's going to be somewhere on those levels. And for the last 2 years, during the COVID, a lot of people, like, they were scared because of this market collapse, etc. And they sold off many shares. And as you can see, despite GB5 share price recovered after the drop in 2020, still it doesn't reflect the growth in earnings. So the earnings growing faster than the price, and that's why P ratio, as you can see, because the company is making more money now than it was making 2 years ago and 3 years ago, right? But the price is lower. So it means that right now it's quite a good buying opportunity. Of course, the share price can go even lower and P ratio can be much lower than here. But again, so if we compare to the previous highs and a normal payment ratio, so you understand that we have a potential like to double at least in earnings. Because if we would say take into consideration that the share price, not share price, but share earnings. Remember, I asked you to remember it was $7.77. So if the company continue to grow, let's say roughly around 7 to 10% annually, so we might see the share earnings will be around $5, let's say in 2 years' time, right? Maybe even more. So, and if we take in $5 multiplied by average P ratio of 15, so the share price could be around $75. Right, so if the earnings grow to $6, so we can expect $6 multiplied by 15 is going to be around $90. So it's quite possible when, emotions like fear will disappear from the market, we might see those prices for GB5 very easily. So if you're a long-term investor, so you can buy it, and also you can enjoy the dividends, because the dividends right now, it's around 7% from the current price. So if you buy at current price, so you're going to get like dividends on that particular level. All right. So price to book level, as I said, it's around just under 4, so 3.59, 3.5. And then return on assets 16. So it's a pretty good one. Return on equity 42, which is much better. Right. So Warren Buffett is trying to find the companies which return on equity is above 20. So here it's double. And then what net margin is 5.8. It's kind of low, but a lot of retailers, they have this type of margin, so quite low margin. All right, yeah, it is definitely a good quality company. It's growing, the revenue growing, profitability growing. So it's pretty nice company. Yeah, I agree with you. And also it is much cheaper right now than it used to be before. Okay, so usually people pay like at least 12 times of their earnings, right? So around 11, 12. And in the good times, like 15 times of their earnings. So when everything recovers back, so this company is going to be evaluated again at those levels. And as a result, if you buy the company now, so you will benefit in the future. So it's nearly 100% growth you can receive.